assets over current liabilities. Current assets over current liabilities. Current assets over current liabilities. Quick ratio. Quick ratio. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Cash plus marketable securities plus accounts receivable over current liabilities. Cash plus marketable securities plus accounts receivable over current liabilities. Accounts receivable turnover. Accounts receivable turnover. Accounts receivable turnover. Net credit sales over average accounts receivable. Net credit sales over average accounts receivable. Net credit sales over average accounts receivable. Day sales outstanding. Days sales outstanding. Day sales outstanding. Days sales outstanding. 365 over accounts receivable turnover.
All right. Good morning. Good morning. It's time to start our work today.
Over accounts receivable turnover.
All right. Let's get going. Father God, thank you very much for this beautiful day. Thank you for knowledge, understanding, and wisdom. Help us, Lord, to understand. Help us to read and be able to dissect this, whatever that is thrown our way to distract us. Help us, Lord, to stay focused and give us understanding, give us wisdom, knowledge, intelligence that comes from you. I pray in Jesus' name, amen. All right. Redwood Co's financial statements had the following information at year-end. We have cash, accounts receivable, allowance for credit losses, inventory, short-term marketable securities, prepaid rent, current liabilities, long-term debt. The question says, what was Redwood's quick ratio? All right, so you know what quick ratio is? It is quick asset divided by current liabilities. Quick asset is not current asset. Quick asset is cash plus accounts receivable plus short-term marketable securities. This is quick ratio. This is quick assets divided by current liabilities. We do have current liabilities. All right, so let's go ahead and do that. Cash $60,000 plus accounts receivable $180,000 plus short-term marketable securities $90,000. That's $330,000. $330,000. we have allowance for credit losses. Okay. All right. So allowance for credit loss will be deducted from accounts receivable. Allowance for credit loss is $8,000. So whatever we got, we will say minus $8,000. So that's $322,000. Okay. So we have cash, we have accounts receivable, allowance for credit losses, inventory, short-term marketable securities, prepaid rent, current liabilities, long-term debt. Whenever we have accounts receivable, and we will be using accounts receivable in the calculation, we need to deduct or subtract allowance for credit losses. We need to subtract allowance for credit losses. Okay, so quick asset is $332,000 divided by current liabilities, which is $400,000. So we have 0.805. 0.81. Okay, so that's close to 0.81. Very good. So when you see in the problem, they give you accounts receivable, and then they give you allowance for credit losses. If you will be using accounts receivable in the calculation, you need to subtract allowance for credit losses. You need to subtract allowance for credit losses. Okay. The following information was taken from Baxter Department Store's financial statements. Inventory at January 1st, $100,000. Inventory at December 31st, $300,000. Net sales, $2 million. Net purchases, $700,000. What was Baxter's inventory turnover for the year ending December 31st? What is the formula for inventory turnover? Cost of goods sold divided by average inventory. Inventory turnover is cost of goods sold divided by average inventory. Is that right? Let me check to see. All right. But we don't have cost of goods sold. We need to find it. Inventory turnover. Just a moment. Okay. All right, cost of goods sold divided by average inventory. That's right. The formula, inventory turnover equals cost of goods sold divided by average inventory. Step 2, find cost of goods sold. How do we find that? You are not given cost of goods sold directly, but you're given beginning inventory, purchases, ending inventory. Use cost of goods sold equals beginning inventory plus purchases. Okay, beginning inventory plus purchases minus ending inventory. Beginning inventory plus purchases. Beginning inventory plus purchases minus ending inventory. Yes. Beginning inventory plus purchases minus ending inventory. This is formula for cost of goods sold. Cost of goods sold beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. So step 3, find average inventory. All right, so we found cost of goods sold, which is 500,000. So now we need to find average inventory. We have beginning inventory, we have ending inventory. So average inventory is beginning inventory plus ending inventory divided by 2, which is 200,000. All right, so now it will become 500,000 divided by 200,000. Right? Inventory turnover is cost of goods sold divided by average inventory. Do we have cost of goods sold? No. So we need to solve for cost of goods sold. Cost of goods sold equals beginning inventory plus purchases minus ending inventory. We found cost of goods sold. Now we need to find average inventory. Average inventory is beginning inventory plus ending inventory divided by 2. And then we can resolve the problem. 2.5. Okay. All right. And this is correct. A company reported the following items on its balance sheet at the end of the current year. Finished goods, $1,750. Work in process, $600. Raw materials, $400. Total inventories, $2,750. During the year, the company reported net sales of $14,500 and cost of goods sold of $11,600. What is the company's number of days in inventory? Number of days in inventory is 365 divided by inventory turnover. Is that right? Let's check to see. This question is testing days in inventory. Inventory turnover, that's right. So the formula is days in inventory, 365 divided by inventory turnover. Or directly, days in inventory. Alright, wait. Alright, 365 divided by inventory turnover. To find inventory turnover is cost of goods sold divided by average inventory. Now you will need to find average inventory. Average inventory is beginning inventory plus ending inventory divided by 2. Once you find average inventory, you will be able to find the rest. But let me see what we got. We have finished goods, 1,750. Work in process, 600. Raw materials, 400. Total inventories, 2,750. So in this case, we would not use the formula that would need average inventory. There is another formula that used ending inventory, which is inventory divided by cost of goods sold times 365. Yes. Inventory, we will use both to see which one gives us the result. All right. So let's start with this. This one. Step 2, what inventory do we use? The question only, alright, let me go here. Step 1, the formula days in inventory, 365 divided by inventory turnover. Step 2, what inventory do we use? The question only gives us or gives one inventory amount. Finished good 1,750, work in process 600, raw materials 400, total inventory 2,750. Since no beginning inventory is given, use the inventory provided as the inventory balance. Step 3, plug into the formula. Days in inventory equals inventory divided by 2,750 divided by 11,600 times 365. What's up with this bird? 86.5. Where did the 11,600 come from? The 11,600 did not come from a calculation. It was given directly in the question. Oh yes. Yeah, cost of goods sold 11,600. Okay. Inventory turnover is cost of goods sold divided by average inventory. Okay. So that's how we found inventory turnover. Then we just divided. Okay. So inventory turnover, cost of goods sold divided by average inventory. So the formula we're using here is days in inventory, 365 divided by inventory turnover. We need to find inventory turnover. Inventory turnover is cost of goods sold divided by average inventory. We have do we have cost of goods sold? Yes, we have cost of goods sold, which is $11,600. So $11,600 divided by average inventory. We were given inventory, which is 2,750. So we do that. Okay, 2,000. Wait. Average inventory divided by cost of days in inventory, 365 divided by inventory turnover. We need to find inventory turnover. Inventory turnover is cost of goods sold divided by average inventory. It seems like we're doing something different. It seems like we're using average inventory divided by cost of goods sold times 365. Okay. Average inventory divided by cost of goods sold times 365. This is another formula we can use. Okay, days in inventory. Let's stick with this one. Days in inventory is inventory turnover. Days in inventory is total inventories divided by cost of goods sold times 365. That's it. 86.5. Okay. Okay, days in inventory, end in inventory, divided by cost of goods sold times 365. Days in inventory measures the number of days it will take to convert inventory on hand into sales by comparing the ratio of ending inventory to cost of goods sold. Cost of goods sold is used because it represents the value of inventory that was sold. Days in inventory is calculated by dividing total ending inventory by average daily cost of goods sold. Alright, let me see what they did. In the ending inventory divided by cost of goods sold. Let me do it myself. Ending inventory 2,750 divided by 11,600 times 365. Okay, that's what it is. Okay. Put in divided by 365 times 365. Okay. Remember that ending inventory divided by cost of goods sold times 365. Days in inventory, ending inventory times ending inventory divided by cost of goods sold times 365. Days in inventory equals ending inventory divided by cost of goods sold times 365. The following information applies to Levering Corp for year 3. Net income 240,000. Dividends paid on common stock 120,000. Common stock outstanding 300,000 shares. The market price per share of the common stock on December 31st is $12. What is Levering's December 31st year 3 price to earnings ratio? Price to earnings ratio. Let's see. Price to earnings ratio. This is price to earnings ratio. Question. Step 1, the formula. Price to earnings ratio, market price per share divided by earnings per share. Market price per share divided by earnings per share. Step 2, find EPS. Okay. Market price per share divided by earnings per share. This is price to earnings ratio formula. Price to earnings ratio, market price per share divided by earnings per share. Let's find market price per share. No, let's find earnings per share, EPS. EPS equals net income minus preferred dividends divided by common shares outstanding, weighted average of common shares outstanding. Okay, notice net income is 240,000, common dividends 120,000. Ignore that. Shares outstanding 300,000. There are no preferred dividends mentioned. They did not mention preferred dividend, and that would confuse someone right away when they say dividends paid on common stock. So when you're calculating EPS, it is net income minus preferred dividends divided by weighted average of common stock outstanding. Now, you have dividends paid on common stock but not preferred stock, which is really important to remember. There are no preferred stock, no preferred dividends mentioned. So EPS equals $240,000, which is net income. So minus nothing, okay? $240,000 divided by common stock outstanding. We have common stock outstanding, which is 300,000. So we do that divided by 300,000. We have EPS. So now that we have EPS, we can go back to price earnings ratio. The formula for price earnings ratio is market price per share. What is market price per share? Step 3, calculate price earnings ratio. Yes, sorry, they gave us market price per share. The market price per share of the common stock on December 31st is $12. Okay, we have it here. So we have market price per share. Market price per share is $12 divided by EPS. EPS is 0.8. So 12 divided by 0.8 is 15. Okay. 15 to 1. Did we understand that? The following information applies to Leverance Corp for year 3. Net income $240,000. Dividends paid on common stock $120,000. Common stock outstanding 300,000 shares. The market price per share of the common stock on December 31st is $12. What is Levering's December 31st year 3 price to earnings ratio? What is the formula for price to earnings ratio? It is market price per share divided by earning per share. Okay, market price per share divided by earnings per share. We have market price per share, it is $12. We don't have earnings per share, so we need to find or solve for earnings per share. Earnings per share, which is EPS, equals net income minus preferred stock dividends. Net income minus preferred stock dividends divided by weighted average of common stock outstanding. So we have net income. Net income is $240,000. Do we have preferred stock dividend? We do not have preferred stock dividend. So what we're gonna do? We will only use the $240,000 minus nothing because we don't have preferred stock dividend. The dividend that's mentioned here is dividends paid on common stock. So we really need to pay attention to that. Dividends paid on common stock. So we don't use that. We ignore that for EPS. Common stock outstanding is 300,000. So we do 240,000 divided by 300,000, and then we have EPS. Since we have EPS and we have the market price per share divided by EPS, and then that's gonna give us the result. Okay, so what we need to remember always is price earnings per share. Price earnings ratio is market price per share divided by earnings per share. All right, price earnings ratio is market price per share divided by earnings per share. And I believe, well, yes, the answer is in the question. Price earnings ratio is price divided by earnings. Yes, market price divided by earnings per share. Price earnings ratio is market price divided by earnings per share. Makes sense? So you can remember that. As soon as you see this, they ask you for a price earnings per share. Price earnings per share. Price earnings ratio. Price earnings ratio. This is the question, but it has the answer inside of it because you need to calculate price per earnings. So it's gonna be market price per share divided by earnings per share. Makes sense. Okay. Why am I doing that? Market price per share divided by earnings per share. Price earnings. All right, let's go. Let's keep going. All right, so Faro Co. is applying for a loan on which the bank requires a quick ratio of at least 1. Faro's quick ratio is 0.8. Which of the following actions would increase Faro's quick ratio? So what is the formula for quick ratio? The formula is quick assets divided by current liabilities. If our quick asset goes up, quick ratio will go up. Yes. So quick asset goes up. What is in quick asset? Cash, short-term marketable securities, in accounts receivable. So if one of these go up, quick ratio will go up. So let's see what we got. Purchasing inventory through the issuance of long-term note. No. Implementing stronger procedures to collect accounts receivable at a faster rate. Yes. Yes. Selling no, this is what it is. Accounts receivable is what affects quick ratio. Selling obsolete inventory at a loss. What? It says selling obsolete inventory at a loss. Wait, which of the following action would increase quick ratio? Quick ratio: cash plus marketable securities plus accounts receivable divided by current liabilities. So let me see what you think. Selling obsolete inventory at a loss. Wow. There are 3 common liquidity ratios. Okay, the current ratio, the cash ratio, and the quick ratio, which is also called the acid test ratio. This ratio assesses an entity's ability to meet short-term obligations. That means current liabilities with liquid assets. That means cash, marketable securities, and accounts receivable. Quick ratios above 1 are considered healthy. For example, a ratio of 1.5 means there is 1.5 of liquid assets to cover each one of current liabilities. Selling inventory increases the quick ratio regardless of whether the inventory is sold at a profit or a loss. Since inventory is not included in the quick ratio, the only effect is to increase cash in the numerator, which in turn increases the ratio. Ooh. Selling obsolete inventory at a loss. What? This is wow. This is a trick. Implementing a stronger procedure to collect accounts receivable at a faster rate. If you increase accounts receivable turnover. Oh, collecting accounts receivable does not mean, collecting accounts receivable does not mean quick ratio is gonna go up because it's the same asset. If you have $20 in accounts receivable, you collect $20, it becomes cash. It did not increase it. It remains the same. Makes sense. That makes sense. Yeah, if you have $20 in accounts receivable, you collect that money. Even though you collect the money right now, it does not increase a quick ratio because accounts receivable just becomes cash, and both are part of quick ratio, so it did not increase it. Selling obsolete inventory at a loss In this case, you increase cash. You increase cash because cash increases, your quick ratio will increase even if you sell it at a loss. Even if you sold it at a loss, yeah, it will increase your cash. Okay. Yeah. Okay, that makes sense. That makes sense. It's just a little deeper understanding of what you're doing. Just a little deeper understanding. Okay. Let's keep going. Let's keep going. All right, what's our next question? Client Co. had the following account balances: cash sales $1 million, net credit sales $3 million, accounts receivable net January 1st $350,000, accounts receivable net December 31st $400,000. What was client's number of days sales in accounts receivable? Days sales in accounts receivable. When you see days sales in accounts receivable, it should be 365 divided by accounts receivable turnover. Yeah, 365 divided by accounts receivable turnover. To find accounts receivable turnover, it's gonna be, alright, cost of goods sold divided by average accounts receivable. If it's the same, let me see. Let me see that. All right, this is days sales and accounts receivable, DSO. DSO, step 1 formula, 365 divided by accounts receivable turnover. Okay. Accounts receivable turnover is net credit sales divided by average accounts receivable. Step 2, find average accounts receivable. Average accounts receivable is beginning accounts receivable plus ending accounts receivable divided by 2, 375. Step 3, find accounts receivable turnover. Use credit sales only, not total sales. Use credit sales only, not total sales. Okay? You have cash sales, you have credit sales. If you're looking for accounts receivable, you cannot use cash. You cannot use cash sales because cash sales cannot be part of accounts receivable. Accounts receivable is anything that you sell on credit. So if you include cash, you will have the wrong result because cash cannot be included in anything that has to do with accounts receivable. Okay. You have cash sales of $1 million. Net credit sales is $3 million. You only use the $3 million of net credit sales. So accounts receivable turnover is $3 million divided by 375,000. This is 8. So find days sales in accounts receivable, 365 divided by accounts receivable turnover, 365 divided by 8, which will be 45.625. All right, so let's go back to this. Days in sales accounts receivable. Day sales in accounts receivable, it's 365 divided by accounts receivable turnover. All right, 365 divided by accounts receivable turnover. Once you see days sales in accounts receivable, days sales in inventory, you will be using the 365. 365 divided by accounts receivable turnover. All right, 365 divided by accounts receivable turnover. Accounts receivable turnover is net credit sales. Remember that. This is what you need to remember. Accounts receivable turnover is net credit sales divided by average accounts receivable. Accounts receivable turnover is net credit sales divided by average accounts receivable. Accounts receivable turnover, net credit sales. Accounts receivable turnover, net credit sales divided by average accounts receivable. Accounts receivable turnover, net credit sales divided by average accounts receivable. Remember that. Accounts receivable turnover, net credit sales divided by average accounts receivable. Accounts receivable turnover, net credit sales divided by average accounts receivable. Net accounts receivable turnover equals net credit sales divided by average accounts receivable. Excellent. All right. Step 2, find average accounts receivable. Average accounts receivable is beginning accounts receivable, which is 350, ending accounts receivable, which is 400,000, divided by 2. So now you have average accounts receivable, and then you can go back because average accounts receivable turnover is net credit sales divided by average accounts receivable. Accounts receivable turnover, net credit sales divided by average accounts receivable. Accounts receivable turnover, net credit sales divided by average accounts receivable. Net credit sales divided by average accounts receivable. Accounts receivable turnover, net credit sales divided by average accounts receivable. So now that you have average accounts receivable, you have net credit sales, which is 3 million. You can find the result. For the 5.6. Oof. We are wrong again. We are wrong again. Inventory. All right. Okay. Let me do that real quick. All right. We're gonna get it. Okay, so notice that now cash sales is $1 million. $1 million is gone. You only have net credit sales 300. Average accounts receivable. Step 2, average accounts receivable turnover is 8. Step 3, days sales and accounts receivable. 45, but 45 48 there close. Okay. All right. Days sales and accounts receivable, average accounts receivable divided by net credit sales. Using numbers shown, average accounts receivable 375 divided by net credit sales times 365. 45. Yeah, let me see something. No, this is getting me confused a little bit. Getting me a little confused. Okay, so let's go back to this. Days in. Nice. 365 divided by accounts receivable turnover. Accounts receivable turnover is net credit sales divided by average accounts receivable. We do that, we can find it. Step 4, days in sale. Okay, so for the 5 point. It's not here. Cash sales 1 million, ignore 3 million. Credit sales, that's what we use. Accounts receivable only comes from credit sales. Cash sales are already collected, so they never enter accounts receivable. Okay, so memory trick. Inventory, use cost of goods sold. Inventory turnover equals cost of goods sold divided by average inventory. Accounts receivable, use credit sales. Accounts receivable turnover is net credit sales divided by average inventory. Average accounts receivable. Then days in inventory, 365 divided by inventory turnover. Days in sales, days sales in accounts receivable is 365 divided by accounts receivable turnover. Okay. I need to confirm that before we move forward. All right, so days sales in accounts receivable is 365 divided by accounts receivable turnover. Accounts receivable turnover is net credit sales divided by average accounts receivable. Solve it. Okay, so you need to find average accounts receivable is beginning accounts receivable plus ending accounts receivable divided by 2. 375,000. Accounts receivable turnover is 8. Days sales in accounts receivable using 365 days. 365 divided by 8, which would be 45.6. Okay. The trick here, many ratio analysis questions use net sales, not credit sales for receivable turnover when both are provided. Net sales is 4 million. No, 34. No. Not net sales. Net sales would not be part of it because we are calculating accounts receivable, and cash sales would never be included in accounts receivable. So net sales is not an option. So we need to find what's going on. Yeah. Okay. All right, so they're testing different formula. The formula that's being tested is ending accounts receivable divided by credit sales times 365. Okay. Day sales in accounts receivable, ending accounts receivable divided by credit sales times 365. This is simpler, straightforward. Ending accounts receivable divided by credit sales times 365. Ending accounts receivable divided by credit sales times 365. Okay? So use average accounts receivable unless the answer choices force another method. But if you work the standard formula and none of the answers fit immediately, check ending accounts receivable divided by credit sales times 365. In this problem, ending accounts receivable is 400,000. Credit sales or net credit sales is 3 million times 365. So the result is 48.7, which looks to be okay. Yes. Okay. All right. So, day sales in accounts receivable is ending accounts receivable divided by net credit sales divided times 365. Remember that. All right, this is another option. If you try 365 divided by accounts receivable turnover, and you find accounts receivable turnover, which is net credit sales divided by average accounts receivable, you find average accounts receivable, and then you resolve. It does not give you the result. Now you will try the other formula, which is ending accounts receivable divided by net credit sales times 365. Okay, remember that. And this is more straightforward. Ooh. Okay. We are almost there. All right, so let's see. Next question. A company reported the following items on its balance sheet. A company reported the following items on its balance sheet. We have cash $800, year 2, year 1 $900, accounts receivable net allowance of $70 and $100. Accounts receivable net allowances of $70 and $100. Year 2 $790, year 1 $850. Inventory year 1 is $420, year 2 $450. Prepaid expenses year 1 $130, year 2 $150. Total current asset, year 1 $2,300, year 2 $2,190. Okay, so the company reported annual sales revenue of $1,900 for year 2. What is its accounts receivable turnover ratio at the end of year 2? Accounts receivable turnover ratio. Accounts receivable turnover ratio. accounts receivable turnover is net credit sales divided by average accounts receivable. Yes, net credit sales divided by average accounts receivable. They have net credit sales. You have cash. Wait. We have cash. We have accounts receivable. Net of allowance 70 and 100. Inventory. Prepaid expenses. Total current assets. The company reported annual sales revenue of $1,900 for year 2. Revenue. What is the accounts receivable turnover? All right, let me do that so we don't spend a lot of time thinking about it. Okay, so identify the formula. Accounts receivable turnover, net credit sales divided by average accounts receivable. Notice the question says accounts receivable turnover ratio, not days sales in accounts receivable. Okay, so step 2, find average accounts receivable. Year 1, 850, year 2, 790. So average accounts receivable is beginning accounts receivable plus ending accounts receivable divided by 2, 820. Step 3, which accounts receivable do we use? The balance sheet says accounts receivable net of allowances. Year 2, 790, year 1, 850. Since accounts receivable is already reported net, do not add back the allowance. Use 790 and 850 exactly as given. Okay, that's trick to confuse you. Step 4, calculate turnover. Sales revenue, $1,900. Accounts receivable turnover is net credit sales divided by average accounts receivable. So that's 1,900 divided by 820. That's 2.317. 2.3. Okay. Notice the wording. Let me see. 2.3. Let me confirm that first. Okay, that's correct. So notice the wording. Accounts receivable net of allowances. Many students think, should I add back the allowance? No. If the ratio asks for accounts receivable turnover, use the same number that appears on the balance sheet. Net accounts receivable, gross accounts equals gross accounts receivable minus allowance. The allowance information is usually there as a distraction. But if they give you gross accounts receivable, they give you allowance, you need to subtract allowance from gross accounts receivable to get net accounts receivable. But the wording here is to confuse you, okay? Because it says that, right, net of allowance receivable. So it's already netted. So just use the number that was given to you. Okay? accounts receivable net of allowances. They give you $70 and $100. In this case, you would say, oh, let me just go ahead and subtract $70 and $100. But remember the wording, it says net of allowances. So they already netted it for you. So if the ratio asks for accounts receivable turnover, use the same number that appears on the balance sheet. The allowance information is usually there as a distraction. Yes, sometimes. Quick ratio chapter rule. Ratio accounts turnover. Alright, so I'm not going to go there right now. Okay, cool. We understand that? Let me go back to the question and see if I understand it. A company reported the following items on its balance sheet. We have cash of $800 for year 2, year 1 $900. Accounts receivable net of allowances of $70 and $100. This would confuse me, but not anymore. I got you. Accounts receivable net of allowances of $70 and $100. And year 1, $850. Year 2, $790. What I was gonna do, but I'm not gonna do it anymore. I'm not going to even talk about it. So it says net of allowances. So it's net. Don't worry about it. Inventory year 1 $420, year 2 $450. Prepaid expenses year 1 $130, year 2 $150. Total current assets year 1 $2,300, year 2 $2,190. The company reported annual sales revenue of $1,900 for year 2. What is its accounts receivable turnover ratio at the end of year 2? So here we're calculating receivable turnover ratio. Accounts receivable turnover ratio is net credit sales divided by average accounts receivable. Do we have net credit sales? Well, it didn't mention if it's cash or credit, but they gave us sales revenue of $1,900, which is what we're going to use. Because it didn't say cash sales, it didn't say whatever. It says sales revenue $1,900 for year 2. So we use that one. What is accounts receivable? Okay, so now we need average net accounts receivable. The average is going to be beginning plus ending divided by 2. And that's how we're going to get it. Okay? Makes sense? Which of the following ratios should be used to compare the profitability of two electronics companies that differ in size? True electronics that differ in size. To compare the profitability ratio. Quick ratio, return on assets, asset turnover, inventory turnover. Profitability, turnover is not profitability. Asset turnover is not profitability. Inventory turnover is not profitability. Return on asset is profitability. Quick ratio is not profitability. Quick ratio, if they're different in size. Which of the following ratios should be used to compare the profitability of two electronic companies that differ in size? If they differ in size, their size is different. So one a very big company, the other one a small company. How do we measure their profitability? Is their return on asset? It's not how much cash they have, because the big company may have more cash than the small, will have more cash than the small company. So it's going to be a return on asset, right? This is what can compare them, because you bought something for $5. They bought something for $50. You sold the one you bought for $5 for $10. They bought it for $50. They sold it for $100. You're just the same, because you make 100%. So return on asset is the one. Yes, that's good. That's good. Great train of thoughts, my friend. Okay. So let me see. Profitability. Okay. Yeah. So your thoughts are good on this. Okay. Return on asset. On January 1st, year 2, the River Company's beginning inventory was 400,000. During year 2, River purchased $1,900,000. $1,900,000 of additional inventory. On December 31st, year 2, River's ending inventory was 500,000. What is the inventory turnover for year 2? Inventory turnover ratio is inventory turnover, cost of goods sold divided by average inventory. Yes, cost of goods sold divided by average inventory. Inventory turnover, cost of goods sold divided by average inventory. So what is the inventory turnover for year 2? Do we have cost of goods sold? Let me see. We can find it, because it says that on January 1st, year 2, the River Company beginning inventory was what? It was $400,000. So this is what they started the year with. They started the year with $400,000. During year 2, River purchased for what? For $1,900,000. So what you're gonna do is 400,000 plus 1,900,000. So you have 2,300,000. So they started the year, or during the year, they had inventory for sale for $2,300,000. So at the end of year 2 now, River's ending inventory was $500,000. So now 500 minus $500,000 is $1,800,000. So cost of goods sold is $1,800,000. What are we looking for? What is the inventory turnover? Inventory turnover is cost of goods sold divided by average inventory. Okay, so now it's $1,800,000, 1.8. Okay, 1.8 million. So now that we have cost of goods sold, we need average inventory. So average inventory is beginning inventory plus ending inventory divided by 2. Do we have beginning inventory? Yes. Beginning inventory is 400,000. Do we have ending inventory? Yes, we do. Ending inventory is 500,000. So we have 900,000 divided by 2. Okay. 900,000 divided by 2 is 450,000. This is average inventory. So cost of goods sold is 1.8 million divided by 450. So that would be 4. Let me see. Did this, that would be good. Excellent, man. Excellent. Huh? We're getting it. We are getting it. That's good. It's 4. What did I do so I can remember? So it says that January 1st, year 2, the river company's beginning inventory was $400,000. That means they started the year with $400,000. During year 2, River purchased for an extra or additional $1,900,000. So during the year, they had $2,300,000 of inventory because they started for $400,000. They put an additional $1,900,000. So during the year, they have a $2,300,000 of inventory. How can you find cost of goods sold in this case? It's gonna be if during the year they had $2,300,000 of inventory. At the end of the year, they had $500,000 of inventory. So we're gonna say total inventory minus ending inventory is gonna give us the cost of goods sold. This is what they sold during the year. It's $1,800,000. So this is how we got cost of goods sold. That's good. This is how we got cost of goods sold. Now that we can find average inventory, it's beginning inventory, which is $400,000, plus ending inventory, which is $500,000, divided by 2. And from there you have average inventory, and you can find the result now. That's good. Okay. A company's common stock has a market value of $45. The company's most recent annual earnings per share is $3.60, and the company pays an annual dividend of $1.50 per share. What is the company's price earnings ratio? Price earnings ratio. Remember, price earnings. Well, that's break time. All right, so when we come back from break, we will continue with this one.
Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Cash plus marketable securities plus accounts receivable over current liabilities. Cash plus marketable securities plus accounts receivable over current liabilities. Accounts receivable turnover. Accounts receivable turnover. Accounts receivable turnover. Net credit sales over average accounts receivable. Net credit sales over average accounts receivable. Net credit sales over average accounts receivable. Day sales outstanding. Days sales outstanding. Day sales outstanding. Days sales outstanding. 365 over accounts receivable turnover. 365 over accounts receivable turnover. 365 over accounts receivable turnover. Inventory turnover. Inventory turnover. Inventory turnover. Cost of goods sold over average inventory. Cost of goods sold over average inventory. Cost of goods sold over average inventory. Days inventory outstanding. Days inventory outstanding. Days inventory outstanding. 365 over inventory turnover. 365 over inventory turnover. 365 over inventory turnover. Asset turnover. Asset turnover. Asset assets.
Total liabilities.
Over total assets.
Total liabilities.
Over total assets.
Debt to equity.
Debt to equity.
Debt to equity.
Debt to equity.
Total liabilities.
Over stockholders'
Total
equity.
liabilities.
Over stockholders'
Total
equity.
liabilities.
Over stockholders' equity. Times interest earned.
Times interest earned.
Times interest earned.
Times interest earned.
EBIT over interest expense.
EBIT.
Over interest expense.
EBIT.
Over interest expense.
Earnings per share.
Earnings per share.
Earnings per share.
Net income minus preferred dividends over weighted average shares outstanding. Net income
Minus preferred dividends.
over weighted average shares outstanding. Average inventory, average inventory, average inventory,
Beginning inventory.
plus ending inventory,
Divided by 2.
beginning inventory,
Plus ending inventory.
divided by 2, beginning inventory,
Plus ending inventory.
divided by 2,
Average total assets.
average total assets,
Average total assets.
beginning total assets,
Plus ending total assets.
divided by 2,
Beginning total assets.
plus ending total assets,
Divided by 2.
beginning total assets,
Plus ending total assets.
divided by 2,
Beginning total assets.
plus ending total assets.
Divided by 2.
Current ratio, current ratio, current ratio.
Current assets.
Over current liabilities.
Current assets.
Over current liabilities.
Current assets.
Over current liabilities. Quick ratio,
Quick ratio.
quick ratio.
Cash plus marketable securities.
Plus accounts receivable.
Over current liabilities. Cash plus marketable securities. Plus accounts receivable.
Over
Current liabilities. Cash plus marketable securities. Plus accounts receivable.
over current liabilities.
Accounts receivable turnover.
Accounts receivable turnover.
Accounts receivable turnover.
Net credit sales.
Over average accounts receivable.
Net credit sales.
Over average accounts receivable.
Net credit sales.
Over average accounts receivable.
Day sales outstanding.
Days sales outstanding.
Day sales outstanding.
Days sales outstanding. 365.
Over accounts receivable turnover.
365.
Over accounts receivable turnover.
365.
Over accounts receivable turnover.
Inventory turnover.
Inventory turnover.
Inventory turnover.
Cost of goods sold.
Over average inventory.
Cost of goods sold.
Over average inventory.
Cost of goods sold.
Over average inventory.
Days inventory outstanding.
Days inventory outstanding.
Days inventory outstanding.
365.
Over inventory turnover.
365.
Over inventory turnover.
365.
Over inventory turnover.
Asset turnover.
Asset turnover.
Asset turnover.
Sales total assets.
Total liabilities.
Over total assets.
Debt to equity.
Debt to equity.
Debt to equity.
Debt to equity.
Total liabilities.
Over stockholders'
Total
equity.
liabilities.
Over stockholders'
Total
equity.
liabilities.
Over stockholders' equity. Times interest earned.
Times interest earned.
Times interest earned.
Times interest earned.
EBIT over interest expense.
EBIT.
Over interest expense.
EBIT.
Over interest expense.
Earnings per share.
Earnings per share.
Earnings per share.
Net income minus preferred dividends over weighted average shares outstanding. Net income
Minus preferred dividends.
over weighted average shares outstanding. Average inventory.
All right, so we're back. Back to work. Back to work. Okay. Let's keep going. Break went by fast. All right, so we were talking about this question. The question is a company's common stock has a market value of $45. The company's most recent annual earnings per share is $3.60. And the company pays an annual dividend of $1.50 per share. What is the company's price earnings ratio? Price earnings ratio is price per share, market price per share, divided by EPS, earnings per share. Do we have market price per share? Company's common stock has a market value of $45. Okay, so market price per share is $45. The company's most recent annual earnings per share is $3.60. Okay, so in this case, we have market price per share, we have earnings per share. So market price per share is $45. Let's keep going. And the companies pay annual dividend of $1. What is the company's price? Okay, so let's do that. 45 divided by what? 45 divided by 3.6. 12.5. Okay. And that's correct. That's good. Okay. This is straightforward formula. The question was, what is the company's price earnings per share? So price earnings per share is market price per share divided by earnings per share. Okay. A company launched a digital campaign targeting new customers, budgeting $900 in hopes of gaining 13,500 customers. The campaign's effectiveness was measured by comparing budgeted new customers with actual customers gained per dollar spent. The campaign resulted in an unfavorable variance of 5 customers per dollar spent. What was the company's actual expenditures and how many customers were gained? All right, so a company launched a digital campaign targeting new customers, budgeting $900 in hopes of gaining 13,500 customers. So what we're gonna do, so that's the budget. Budget $900 for 13,500 customers. The company effectiveness was measured by comparing budgeted new customers with actual customers gained per dollar spent. The campaign resulted in an unfavorable variance of 5 customers per dollar spent. 5 customers per dollar spent. That's the variance. What was the company's actual expenditure? And how many customers were gained? Oh. Let me do that first. So if you spent $13,000, no, you spent $900 for 13,000 customers. So how many customers for each dollar you spent? Let me see. 900 divided by 13,500. No, wait. 13,900. 500 divided by $900. It's 15. So 15 customers for each dollar you spend. All right. 15 customers for each dollar you spend. But here it says that there was a variance of 5 customers per dollar spent. So instead of getting 15 customers, they got 10 customers per dollar spent. What was the company's actual expenditure? And how many customers were gained? Well, actual expenditure oh, that's okay, wait. All right, let me do that. I know I could take some time to think about it, but that's gonna take too much time. Okay, let's do that instead. This is logic. Alright, this looks like a variance analysis question, but let's solve it with logic. Well, exactly. Step 1, find the budgeted customers per dollar. Budgeted expenditure $900. Budgeted customers 13,500. Okay, so 13,500 divided by 13,500 divided by 900 is 15. Exactly what we did. So the company expected to gain 15 customers per dollar. Step 2, understand the variance. The question says unfavorable variance of 5 customers per dollar spent. So 15 minus 5 is 10. So we have 10 customers per dollar spent. Actual effectiveness, 10 customers per dollar. Step 3, test the answer choices. We need actual customers divided by expenditure equals 10. Okay. Actual customers divided by actual expenditure equals 10. So I need to understand that. Expenditure, okay. Compute budgeted rate. 13,000, okay, 13,500 divided by 900 equals 15. Apply unfavorable variance, which is 15 minus 5 equals 10. Look for answer where customers divided by expenditure equals 10. Okay, makes sense. But would I need to go through all of the answers, or is there a way to just calculate it without even seeing the answers? Extra expenditure, extra customers. Budgeted rate 13,500 divided by 900 equals 15. Customers per dollar, $15 customers per dollar. Extra rate unfavorable by 5 customers per dollar. So it's 10. That's what they got. So C on E equals 10. Customer on expenditure equals 10. Or C equals C 10E. Alright, now here's the problem. That is the only equation that the question gives you. One question, two unknown. I see. There are infinitely many answers. All satisfy C divided by E equals 10. Therefore, this is actually a multiple choice recognition question. You cannot uniquely solve for both actual expenditures and actual customer without the answer choices. I see. I see. Okay. So you need to use the answer choices to find the answer. I see. So customers divided by expenditure equals 10. All right. Expenditure 1,000. Okay, so you go to the answer choices. Customer divided by expenditure needs to equal 10, and that would be the one that's correct. Okay. Customers gain 11,000, expenditure 1,000, 1,100. Okay. That makes sense. Customers gain divided by actual expenditure equals customers per dollar spent. Customers gain divided by actual expenditure equals 10 customers per dollar spent. Variance analysis compares current period amounts with prior period or budgeted amounts. Companies uses variance analysis to identify areas for improvement and then take corrective action, thereby improving overall performance. Okay, let's go. During year 2, Dunn Company purchased $1,920,000 of inventory. The cost of goods sold for year 2 was $1,800,000, and the ending inventory at December 31st, year 2 was $360,000. What was the inventory turnover for year 2? What is the formula for inventory turnover ratio? Is cost of goods sold divided by average inventory. Inventory turnover, cost of goods sold divided by average inventory. That's almost the same as the question we just did earlier. During year 2, Dunn company purchased $1,920,000 of inventory. Okay, the cost of goods sold for year 2 was $1,800,000. We have cost of goods sold, and the ending inventory at December 31st, year 2 was $360,000. What was the inventory turnover for year 2? Okay, we have cost of goods sold. What we don't have is average inventory, which we can find, because it says that during year 2, Dunn Company purchased $1,920,000 of inventory purchased. So that may not be beginning inventory. The cost of goods sold for year 2 was $1,800,000. Okay, so we have cost of goods sold, we have ending inventory. We should be able to find beginning inventory. All right. Yeah, so cost of goods sold equals beginning inventory plus purchases minus ending inventory. So ending inventory will equal what? I should be able to think this through. That's not so hard. All right. So now what I need, we have ending inventory. I need beginning inventory. Okay. So let's do this. They purchased for $1,920,000. And then they sold for $1,800,000. I'm gonna do this. All right. So if you sold for $1,800,000. Okay, let me do that. $1,920,000 minus $1,800,000 is $120,000. 120,000. I need to have 360,000. So what's missing? 160,000 minus 120,000. That's no. $240,000. Beginning inventory should be $240,000, because if you begin with $240,000 and then you purchase for $1,920,000, 240,000 plus 1,920,000, it's 2,160,000. 2,160,000 minus 1,800,000 is 360. Exactly. Okay. So beginning inventory is $240,000. So I have beginning inventory $240,000 plus ending inventory 360,000. 600,000 divided by 2, 300,000. All right. So average inventory is $300,000. Cost of goods sold is $1,800,000. The cost of goods sold, okay, $1,800,000 divided by 300,000. Okay. Divided by 300,000. So that's 60. What was the inventory turnover for year 2? Cost of goods sold divided by average inventory. It gives me 60. Wait, I'm missing a zero somewhere. Cost of goods sold, 1,800,000 divided by average inventory, 6. Yes, 300,000 is 6. Exactly. We got it. Let me see what they did. Cost of goods sold 1,800,000 and plus ending inventory 360,000. Cost of goods sold available for sale is 2,160,000 minus purchases. Okay, that's exactly what I did. Okay, that's good. That's good. All right. A company has the following financial information. Current asset for year 1, 200,000. Year 2, 230,000. Total assets, year 1, 1 million. Year 2, 1,230,000. Stockholders' equity, year 1, 400,000. Year 2, 480,000. Sales, year 2, 700,000. Cost of goods sold, year 2, 500,000. Operating expenses, year 2, 65,000. Net income, year 2, 80,000. Okay. What is the company's return on assets for year 2? Return on assets. Net income. Return on assets is net income divided by what? Return on asset, net income. What is the formula for return on asset? Net income divided by asset turnover. Average total asset, okay. Net income divided by average total asset. All right. You have net income of $80,000. Average total asset. Okay, you have asset for year 1, asset for year 3. You can find average total asset, which is 1 million plus 1,230,000. That would be 2,230,000. Yes. All right. So net income divided by that. Net income is 800,000 divided by 2,230,000. 0.35. What is the company's return on asset for a year? Return on asset is a percentage. Yes. It would be 35%. But no, this is not available. I have 12%, 6%. All right, let me see. I'm missing something. Current asset. Total asset. Okay. Stockholders' equity. Sales. We have sales. Cost of goods sold. Operating expenses. should you exclude operating expenses from asset? Let me see something. We're not too far off, but something is not clicking yet. Okay. Return on asset is net income All right, give me just a second. Gotta take this call. Hello, man. Não fala, gasta de como ela na outra. Nada mieux là qu'on y a. Yo là, yo. Merde, bien que t'as bien. C'est bon. All right, let's go back to work. Okay, so we were saying return on asset equals net income divided by average total assets. Step 2, find net income. Oh, net income. Net income is here. Find net income. The question already gives net income equals 80,000. Don't calculate it from sales, cost of goods sold, and expenses. They already did that work for you. Okay, yes, we already have net income. Step 3, find average total assets. Beginning year 1 and then year 2, which is what we did. Did I do that? 1 million plus 2 million divided by 2. I didn't do the divided by 2. I didn't divide it by 2. That's the problem. I did not divide it by 2. What did I do? Yeah. So 2,230,000 divided by 2. Wow. Why would I do something like that? 1,115,000. So that's where we'd say 80,000 divided by 1,115,000. 0.69. Zero point 69, 0.071, 1,115,000, 80,000 divided by 1,115,000. 1,115,000. Yeah, 0.07, which is 7%. That's good. That's what I did not do. But yeah, we were not too far off. But we gotta know what we're doing. Okay. Not too far off. Okay, a company has cash. A company has cash of $1 million. Accounts receivable 600 million. Current assets of 1.2 billion. Accounts payable of 400 million. And current liabilities of 900 million. What is its asset test ratio? Which is the quick ratio? Quick ratio is quick asset divided by current liabilities. So company has cash of 100 million, which is part of quick ratio. Quick asset, accounts receivable 600 million. We have current assets, not part of it. Accounts payable and current liabilities of 900 million. Okay. We can do this real quick. We have 100 million cash, 100 cash plus 600 million accounts receivable. That's 700 million. All right, so we have 700 million in quick assets. Current liabilities, let me know, 700 million divided by current liabilities 900 million. Is 0.78. I have 0.78. Okay, exactly. That's good. We're moving on quick. Main co sales total $300,000 for the current year. Main's cost of goods sold was $150,000. Main's accounts receivable balance was $20,000. on January 1st and $30,000 on December 31st, what was Maine's accounts receivable turnover rate for the current year? Accounts receivable turnover equals cost of goods sold divided by average accounts receivable. What is cost of goods sold? Maine has total sales of $300,000. Maine's cost of goods sold was $150,000. So we have cost of goods sold, $150,000 divided by average accounts receivable. So average accounts receivable, we have beginning and we have ending accounts receivable. 20,000 plus 30,000 divided by 2, that's 25,000. All right, so cost of goods sold divided by 25,000, which is 150,000 divided by 25,000. 150 divided by 25. That's 6 times. No, 12 times. What happens? Cost of goods sold 150,000. Accounts receivable balance was 20,000 January 1st and 30,000 December 31st. So beginning accounts receivable is 20,000, ending accounts receivable is 30,000. That's 50,000 divided by 2, that's 25,000. Okay. Net sales, not cost of goods sold. This is when you're talking about inventory. Ooh, net sales. They did it on purpose. Net sales divided by average accounts receivable. Man, Coles has total sales totaled 300,000 for the current year. 300,000 divided by 25,000. Wow. Exactly. 300,000. 12. How could you trick me like that? We're talking about what? We're talking about accounts receivable turnover. Accounts receivable turnover is net sales. Net sales divided by average net accounts receivable. Inventory turnover is cost of goods sold divided by average inventory. Do not confuse them. Accounts receivable is net sales. Accounts receivable turnover is net sales divided by average net accounts receivable. Remember that. Accounts receivable turnover is net sales. Accounts receivable sales. Net sales divided by average net accounts receivable. Inventory turnover is cost of goods sold divided by average inventory divided by average inventory. Okay, remember that. This you need to remember it. Okay, remember that. So,
What do you want to be reminded about?
these devices think they are human. You're not human. I'm not talking to you. Okay. So, accounts receivable turnover is net sales divided by average net accounts receivable. Inventory turnover is cost of goods sold divided by average inventory. Okay, you can remember that. Accounts receivable, it has to do with sales. you sell to have accounts receivable. Inventory, cost of goods sold, the things that you buy. Cost of goods sold, the things that you buy, divided by average inventory. Accounts receivable, for you to have accounts receivable, you need to sell something. So that's why it is net sales divided by average net accounts receivable. Inventory turnover, you need to buy things or sell things or sell your inventory. So it's cost of goods sold. Cost of the inventory that you sell divided by average inventory. Okay, good. You will remember that. You tricked me on that once, but not twice. The controller of Peabody Inc. has been asked to present an analysis of accounts receivable collections at the upcoming staff meeting. The following information is used. Accounts receivable, December 31st, year 2, 100,000. December 31st, year 1, 130,000. Okay. December 31st, year 2, December 31st, year 1. Allowance for credit loss, 20,000, year 2, 40,000, year 1. Sales, 400,000, year 2, 200,000, year 1. Cost of goods sold, 350,000, year 2, 170,000, year 1. What is the receivables turnover ratio as of December 31st, year 2? Accounts receivable turnover is net sales. Is it total sales or net sales? Net sales divided by average net accounts receivable. What do we have? We have accounts receivable. We have allowance for credit losses. We have sales. Okay. We are not using cost of goods sold. All right, so we have sales, $400,000 for year 2. This is what we're going to use. Divided by average net accounts receivable. So we need to have net accounts receivable. How do we get it? It's accounts receivable minus allowance for credit losses. So 100,000 for year 2 minus 20,000 is 80,000 for year 2. For year 1, 130,000 minus 40,000 allowance for credit losses. It is 90,000. Yes. 90,000. 130,000 minus 40,000. It's 90,000. Okay. So 80,000 plus 90,000. Or 90,000 plus 80,000 equals 170,000 divided by 2. That's 85,000. So we have average net accounts receivable. So 400,000 divided by 85,000. It's 4.7. 4.7. Excellent. Good job. Good job, good job. The following information pertains to Dalton Co. Net sales during the year, 750,000. Gross profit margin, 60,000. That's a bird. Gross profit margin, 60%. Ending inventory, 100,000. What is Dalton's number of days in inventory? Days in inventory is 365 divided by 365 divided by inventory turnover. Inventory turnover, or you can do, let me see, net sales during the year, gross profit 60%, ending inventory. All right, let me do that instead of spending time to think this through. I could, but okay. This is a good ratio question because they don't give you cost of goods sold directly. Step 1, find cost of goods sold. You are given net sales 750,000, gross profit margin 60%. Gross profit margin equals gross profit divided by sales. So gross profit equals 750 times gross profit margin equals gross profit. What are we doing? Gross profit equals 750,000 times 60%, 450,000. Now cost of goods sold equals 750,000 minus 450. Find inventory turnover. Inventory turnover is cost of goods sold divided by inventory. Step 3, find days in inventory. 365 divided by inventory turnover, 121. Inventory divided by cost of goods sold times 365. Okay. Inventory divided by cost of goods sold times 365. Let me see this. All right. Inventory times cost of goods sold divided by 365. We need to find cost of goods sold. All right, let's start from this formula. Days in inventory equals inventory divided by cost of goods sold times 365. And then now we need to find cost of goods sold. Give me the detailed flow of how we do it. All right, start with what the question is asking for. The question asks days in inventory. So your brain should immediately go to days in inventory. Inventory divided by cost of goods sold times 365. Now ask, do I have inventory? Yes, inventory is 100,000. Do I have cost of goods sold? No. Therefore, Need to find cost of goods sold. Step 2, what information is available? We have sales, we have gross profit margin, which is 60%. Now ask, what does gross profit margin tell me? It tells me gross profit margin equals gross profit divided by sales. Step 3, solve for gross profit. Rearrange gross profit equals sales times gross profit margin. Substitute that. Okay, so we have gross profit equals 450,000. Okay, so step 4, use the gross profit formula. Now ask, where does gross profit come from? The formula is gross profit equals sales minus cost of goods sold. Alright, gross profit equals sales minus cost of goods sold. Substitute. Okay, so 450,000 equals 750,000 minus cost of goods sold. So cost of goods sold, you solve for cost of goods sold, is 750,000 minus 450,000, which is 300,000. This is cost of goods sold. So return to the original formula. Remember, the question was asking for days in inventory, which is inventory divided by cost of goods sold times 365. So now we substitute. That's how we get the 121.7. Okay, so this is simple, but you need to go through finding different formula to find your answer. Days in inventory, inventory divided by cost of goods sold times 365. Days in inventory is inventory divided by cost of goods sold times 365. We need to find cost of goods sold. What information is available? We have sales, we have gross profit margin. Now ask, what does gross profit margin tell me? It tells me gross profit margin equals gross profit divided by sales. Gross profit margin is gross profit divided by sales. Now, if I can get gross profit, I can get cost of goods sold. That's the thought. Solve for profit. For gross profit, gross profit equals sales times gross profit margin. So you find gross profit. So now use gross profit formula. Gross profit equals sales minus cost of goods sold. Gross profit equals sales minus cost of goods sold. And then now you can find cost of goods sold. You can resolve the problem. Okay. Oof. For a company that has only common stock outstanding, total shareholders' equity divided by the number of shares outstanding represents the what? Total shareholders' equity divided by the number of shares outstanding. Equity divided by shares. What formula is that? Equity divided by shares. Equity divided by shares. Price earning is market price divided by earnings per share. But here they say total shareholders equity divided by number of shares outstanding. Equity per share. So return on equity. Yeah, equity per share, return on equity. Yeah. No, book value per share. Wow. It is book value per share. All right, so return on equity is found by dividing net income by average common stockholders' equity. Okay. Book value per share is defined as total common equity less the portion allocable to preferred stock, if any, divided by the number of common shares. It is a measure of the amount of common stockholders' equity in each share of stock. Okay, so book value per share. Book value per share. Book value per share is common stock outstanding. All right, book value per share for a company that has only common stock outstanding. Book value per share is total shareholders' equity divided by the number of shares outstanding. Book value per share, total shareholders' equity divided by the number of shares outstanding. Book value per share, total shareholders' equity divided by the number of shares outstanding. Okay, book value per share. Let's keep going. A company reported the following items for the current year: net credit sales $500,000, net cash sales $150,000, accounts receivable net January 1st $75,000, accounts receivable net December 31st $90,000. What is the company's accounts receivable turnover ratio? Accounts receivable turnover, it's net sales divided by average account receivable. Average account net accounts receivable. Average net accounts receivable. Okay? So net sales, we have it 500,000. Average net account receivable, that's what we don't have, we can find it. So how we find it is beginning net account receivable, which is 75,000, plus ending plus 90,000 equals 165,000 divided by 2, 82,500. So net sales is 500,000 divided by 82,500. It's 6.06. I have a 6.1. We could use the 6.1. Correct. Excellent. All right, this is our last question for the day. Financial information about a company is as follows. Net sales, 1,800,000. Cost of goods sold, 1,200,000. Beginning inventory, 336,000. Ending inventory, 288,000. What is the company's number of days in inventory? Number of days in inventory is 365 divided by average inventory divided by average inventory. Divided by inventory turnover. Number of days in inventory. Number of days in inventory is 365 divided by inventory turnover. Inventory turnover equals cost of goods sold divided by average inventory. Or we can do, there is another formula. The other formula is net sales divided by cost of goods sold times 365. I'm not sure yet. All right, so let's use the easiest, the exact thinking chain we just built. What is the question asking? Number of days in inventory. Days in inventory, average inventory divided by cost of goods sold times 365. Step 2, do we have cost of goods sold? Yes. No extra work needed. Do we have inventory? We have beginning inventory, yes, okay. So days in inventory, 0.26. So what's the average inventory divided by cost of goods? Days in inventory. Why we're not using the 3? Plug in the formula. Days in inventory, okay, times 365. $94.9. Okay, so we can do that. It's cost average inventory divided by cost of goods sold times 365. Days in inventory, average inventory divided by cost of goods sold times 365. Average inventory divided by cost of goods sold times 365. Days in inventory is average inventory divided by cost of goods sold times 365. And then that will give you the answer, 94. Okay. All right, so 94.9 is not part of the answer. Not part of the options. Okay. Yeah. Net sales, cost of goods sold, being days in inventory, average inventory divided by cost of goods sold times 365. It's 94.9. If that's not the answer, then the test writer is probably using ending inventory instead of average inventory. So ending inventory divided by cost of goods sold times 365. All right, ending inventory divided by cost of goods sold times 365, 87 point something. Okay, 87.6. Yeah, so that's the right one. So how do we know when to use ending inventory or average inventory? Even when the problem is talking about beginning inventory and ending inventory, that would immediately make me think about average inventory, but that doesn't give the answer. This is exactly the right question. Huh? You're not trying to memorize formulas anymore. You're trying. Okay. In the real world, and on most questions, if you see beginning inventory, ending inventory, your first thought should be average inventory. Right? Why? Because inventory changes throughout the year. If I started with 336,000, ended with 288,000, neither one represents the whole year. The average does. That's why cost of goods sold divided by average inventory times 365. There's an inventory, average inventory, all right? Are the standard formula. This is the standard formula. Days in inventory, average inventory divided by cost of goods sold times 365. So why did that question seem to want ending inventory? Because some review questions and textbook use a shortcut. Ending inventory divided by cost of goods sold times 365. Okay. Ending inventory divided by cost of goods sold times 365. It could be average inventory, it could be ending inventory. Ending inventory divided by cost of goods sold times 365. Okay, that's it. All right, this was our last question for today. We went through 20 questions. That's amazing. All right, well, thank you very much for sticking around. If anyone was sticking around, have a great day.
Current ratio, current ratio, current ratio.
Current assets
Over